All right. Thank you, everyone, for joining us today. This is the Crux third quarter market update webinar and conference call with a couple of our industry experts. Our CEO, Alfred Johnson, will be leading the call today. My name is Katie Bays. I'm our policy and research strategist here at Crux. If you have not yet had a chance to download our third quarter market update, I will be dropping that link into the chat here in just a moment. We are going to take a little bit of time to let folks join the conference call. I can see we have quite a few participants filtering into the call, so we'll plan to start the call just a minute or so after the top of the hour. Once again, thank you all so much for joining. This is the Crux third quarter market update conference call. This webinar is going to be recorded, so as soon as we begin and we pass the call off to our CEO, Alfred Johnson, we will be recording the webinar, and that link is available or will be available for folks to view and download the webinar recording after it has been completed. The report from which the data that we will present today is derived is available on our website for download, and folks who have not already done so, I encourage you to check that out. We'll be getting started here in just a minute. I look forward to the opportunity to present our third quarter market update findings with everyone. And with that, I'd like to hand the call over to our CEO, Alfred Johnson, to share our findings from our third quarter market update. Hey, Alfred.
Hey, Katie. Thank you. I see we have a lot of people that are on the call already and more people joining, but we got a lot to get through, so I'm going to get going. Thank you all for joining the third quarter market update presentation. We're incredibly lucky, excited to be joined by Eli Katz of Latham & Watkins and Jerry Smith of Atlantic Risk. I'm also joined by my colleague, Stephanie Detterding, who faces the buy side of the market for us. As Katie mentioned, my name is Alfred Johnson. I'm the co-founder and CEO of Crux, and really excited to get into this with all of you. Great. So we'll do two principal things in the hour that we have together. First, I will run through some slides that summarize the data that is covered in our third quarter market update. That'll take about 15 minutes, and then we'll go to a panel discussion about the data and other observations on the market with Eli, Jerry, and Stephanie. So we'll start that after we throw some numbers at all of you, which I know that people are eager to get into. So quickly to set the table without belaboring it, the government created a new multi-$100 billion asset class and transferable tax credits in the IRA. The categories of technology that are eligible for these tax credits are listed on the right-hand side of the screen here. Broadly, they fall into categories related to renewable electricity, advanced manufacturing, carbon capture, EV charging, and we're seeing the market in all of the categories flourish with the transferability mechanism, which is driving more capital into these projects via directly transferable tax credits, which is a change from the way that we have historically managed the monetization of tax credits, which historically have been monetized through partnership structures through what is known as the traditional tax equity market. Knowing who is on the call here, I know that we have a lot of experts that are quite familiar with all of these mechanisms. So quickly on Crux's third quarter market update, we produce these updates and these reports regularly. In this quarter, we have updated pricing statistics on the market by technology category. We'll share data on market composition, overall sizing statistics and estimates, and some measures of liquidity, which are new to the third quarter update. The data in here synthesizes about $28 billion of commercial data that is received by surveys, public announcements, and Crux platform bidding data. We've seen about $18 billion of bids on platform that is integrated directly into the data set. Deals in the sample reflect more than 10 different technology types, including the first nuclear PTC transactions, which were collected in the third quarter. And data that we present here is integrated directly into the Crux platform via a feature that we call the Crux Emit that allows sellers to see market pricing on projects that they may be listing and buyers to align their bids to the observed market pricing by technology category, size, et cetera. The third quarter report has four key findings. One, tax credit supply is diversifying. The data in the first half of the year showed that there was overwhelming credits in the market from wind, solar, and storage. It was a broader mix of credits that transacted in the third quarter. Pricing is generally rising for all sizes and credit types. Buyer interest is increasing in forward commitments. The market on 2024 tax credits has become reasonably constrained, and that is necessarily leading both buyers and sellers to start to look forward in their bidding and trading behavior. And the tax credit market is becoming more liquid and more highly transactable even than it was in the first half of the year. And we'll show some data on that. So the market is growing and diversifying. Quickly on size, in the first half of the year, we were able to identify $6.8 billion of specific transactions that led us to the estimate that 9 to 11 billion transacted in the first half of the year. We believe another 7.5 transacted in the third quarter of this year, bringing total deal volume on 2024 credits to between 16 and 18.5 billion. Frankly, given that we are now at the end of October, that number is higher as more deals have transacted in October. Inclusive of the deals that are sold out of tax equity partnership structures, we expect the total market volume in 2024 on direct transfers to be between 22 and 25 billion. This is an update to our prior estimate of 20 to 25 billion. Basically, we believe that we are now de-risked on being at the higher end of the range that we had previously anticipated. And in addition to the transfers, we estimate that roughly another 25 billion of traditional tax equity will occur. And so what you have is about 25 billion of traditional tax equity, about 25 billion of transfers. Obviously, those are not mutually exclusive to each other. Some traditional tax equity is formed and credits are sold from the partnerships. So the total monetized tax attributes may be less than 50 billion. We estimate somewhere between 40 and 50 billion. But you have transferability now making up on a volume basis, approximately the same volume that traditional tax equity would make up in the 24 market. I mentioned earlier that we're seeing increasing diversity in the market in the third quarter. What I'm showing you here are pie charts of the market by technology type in the first half of the year and then just in the third quarter. And what you see in the first half of the year is that wind, which is the pink, solar, which is the yellow, red, solar and storage, and light blue storage make up about 85% of the total market in the first half of the year. Just to put that into plain English, utility scale, wind, solar storage traded in larger increments and made up a higher percentage of the market in the first half of the year. In our first half of the year market report, we anticipated that in the rest of the year, we would see more diversity of credits in market, and we saw that in the third quarter. So you can see that pink is advanced manufacturing credits covered under Section 45X. That was about 12% of the market, we think, in the first half of the year, made up about 40% of the market in the third quarter, and we anticipate that to grow. The wind, solar, storage components of the market reduced across the board. So wind was a large piece of the market, particularly in production tax credits in the first half of the year. That's represented in the pink at about 26% of the market in the first half. That became 2% of the market in the third quarter. And again, what is shown there, what is indicated is that the wind production tax credit deals, which are among the most desired in the market, traded in the first half of the year. And there has been replacement from other categories of credits, advanced manufacturing being one, but also nuclear, bioenergy, EV charging infrastructure as guidance came out from the Treasury Department. So what you see is a broader mix of credits in the third quarter. The government is continuing to put out guidance on different credit categories, even as the election looms. The advanced manufacturing production tax credit final guidance came out last week. The most notable updates to that guidance include the potential for miners that are producing critical minerals to account for material costs, including the extraction and acquisition costs. That was an unknown question going into the guidance, something that many had hoped the government would address, which they did. And recycled materials may also now be used to justify the 45X production tax credit. The material impact of that guidance, when you think about the market in aggregate, is that 45X, which is already a growing segment of the market, will represent even more supply as more credits are able to take advantage of that credit. We're seeing strong pricing in tax credits across all categories. I mentioned earlier that wind PTCs are the most desirable credits in the market, as demonstrated by price. In general, on pricing, there are a couple of themes that have remained true across all of the quarters that the market has been active. Production tax credits trade at a premium to investment tax credits. You see larger deals trade at a premium to smaller deals, and established technologies trade at a premium to newer technologies. What I'm showing here is the spot wind PTCs. What you can see is that pricing in the third quarter, which is represented in the teal, is improved versus pricing in the second quarter, which is shown in the light green, across the board at every credit size in wind production tax credits. But you also see a good amount of stability in high pricing, even in small deal sizes. So small wind production tax credits might trade at 93.5 cents on average. Very large wind production tax credits might trade at 96 cents. But there's pretty good stability in pricing across the curve. You see a bit less of that in investment tax credits. Before we turn to ITCs, quickly to address 45X, advanced manufacturing production tax credits, we see about a 1 cent to 1.5 cent reduction in price on 45X credits versus wind PTCs, but still very strong pricing across the board, with the largest credits in advanced manufacturing pricing on average at 95 cents. There have been deals that have been announced in the market as high as 96 cents. So once you're at the top of the range in terms of size, you see advanced manufacturing production tax credits trade more like wind PTCs. Average pricing on solar ITCs is a bit lower than production tax credits. This is partially because, or largely because of the risk of recapture associated with ITCs. And also I should note that everything that we are quoting here is gross pricing. So there may be other fees that are incurred by the developer manufacturer in selling credits. In solar ITCs in particular, we see insurance covering at least some of the risks associated with the transaction in the overwhelming majority of cases. So the net price received by the developer might be reduced by the cost of insurance, and we can get into that with Jerry from Atlantic. But broadly, even though the pricing is a bit lower than production tax credits, we did see an improvement in solar ITC pricing in the quarter from the second quarter to the third quarter, and pricing is still strong here versus expectations. And also, I should note that at the smallest end of the range for ITCs, that is the segment of the market that had the least access to tax equity, traditional tax equity, prior to the advent of transferability. So even if net pricing or total pricing on smaller ITCs is a bit lower than observed on production tax credits, for example, this is still a very valuable mechanism that is driving significantly more capital to smaller developers than they previously had access to. Lastly, on bioenergy ITCs, we see bioenergy ITCs at about 5% of the market. That will probably represent a bit more of the market in the fourth quarter, as other credit types have now sold off in 2024. Bio ITCs trade at a discount of a couple cents from solar ITCs. They also carry the risk of recapture relative to production tax credits. And often there is insurance that buyers are securing or sellers are securing to the benefit of the buyer that is embedded in the pricing that you see here. Great. With that, I'm going to hand it over to my colleague, Stephanie Detterding, who faces the buy side of the market for Crux on what we're seeing in the forward market and different behavior that we're starting to observe from buyers. Stephanie?
Yeah, thanks, Alfred. Yeah, so what we're talking about here is a forward tax credit purchase being a binding commitment from a buyer to purchase tax credits that will be generated in a future year. So we're not talking about intra-year commitments for tax credits. And the other important item to note is that typically buyers are paying for tax credits after they're generated. So even though they're entering into a commitment to purchase tax credits, they would actually not be paying for those tax credits until after they're generated. So what this slide is showing here is that for Q3, we saw a material increase in the amount of bids for future credits. We went from 15% in Q2, and now almost a third of the bids that we were seeing in 25 related to 25 and beyond. Alfred, if you could go to the next slide, and I can kind of discuss why this is happening. So right now we know that 2024 supply is constrained, and what buyers are doing, and the buyers that have the ability to plan, they're looking ahead to future tax years, and they're receiving benefits for looking ahead. So there's a wider market to be had, less competition for those buyers who can predict out reliably their tax appetite. And depending on the credit, they may also be able to secure discounted pricing. On the sell side, the reason that we are seeing this play out as well is that sellers are coming to Crux earlier and earlier in their process, sometimes pre-construction, and they're looking to secure a forward commitment from a buyer. They want certainty around pricing and execution, and they are utilizing this commitment to unlock additional financing. And we actually have an individual, Andrew Chung from Crux, who's leading our capital markets efforts and is really actively supporting developers in all of their capital needs as they're looking to not only secure this forward commitment, but also other parts of the capital stack that are emerging beyond traditional tax equity. So you can see on this slide clearly that there's still additional supply for 2025 available.
Great. Thanks, Stephanie. Okay, last and final theme before we hand off to the panel. The tax credit market is liquid and increasingly transactable. Quickly to share some data on what that looks like in the market. So on Crux, we're seeing about 63% of credits that are listed in the third and fourth quarter receive a bid within the first week of listing. 78% of 2024 credits received at least one bid. And the average number of credits that we are seeing or bids that we are seeing per credit is 2.3. Though I would point out that in the largest segments, so deal sizes above 150 million, we're seeing coverage at about 3.8 bids per credit. So the pricing that we observe in higher deal sizes is also reflected in the number of bids that those credits are getting. And of course, that makes sense. The more competitive the market is around the credit category, the more the price will appreciate. On what the market activity and the depth of the bid looks like on the platform, we're seeing, again, acceleration across the board, a multiple of the bidding activity that we saw in the first and second quarter. On Crux, that is a mix of direct buyers and buyer advisors. So direct buyers come to the market and are able to source credits. Buyer advisors also play a critical role in this market, helping buyers to navigate these transactions. We at Crux are reasonably indifferent to the way that people find the market. We work very closely with buyer advisors to help their clients navigate the market and source liquidity. And for sellers, you're able to access both direct bids and advised bids via the platform, which contributes to the liquidity that we see on Crux. Deals are closing quickly. We see in production tax credits the average deal, 66% of deals are closing in 6 weeks or less, under 42 days. The remainder are closing within 3 months. With investment tax credits, 96% are closing within 6 months, but a majority are closing within 6 weeks to 3 months, or the plurality is closing within 6 weeks to 3 months, and the majority is closing in under 3 months. So overwhelmingly, the market is getting faster in deal execution. That is supported by things like standard documents, people having really great advisors at the table, and people coming to the market for the second and third time as the market continues to evolve. So I think this market will become even faster and more efficient with the support of technology and all of those other supports. So with that, I'm going to pause the presentation, invite in my friends, Eli, Jerry, and Stephanie, and we'll talk about the data that was just presented. But first, before we get in that, we're so lucky to have people that have spent so much time around this space. And I want to make sure everybody understands the backgrounds that you guys bring to this conversation. So Eli, can you start with your background, how you entered the conversation, and some of the things you've observed, and then I'll go to you, Jerry.
Sure, Alfred, thanks for having me. My name's Eli Katz. I'm a tax lawyer at Latham & Watkins, a large law firm, and I'm part of a large group of transactional lawyers that works on transactions across the energy sector. Recently, we've had a lot of focus on representing tax credit buyers and sellers, and we also played a pretty large role in commenting and helping Treasury implement the rules. So pleasure to be here with you today. Thank you.
Awesome. Jerry?
Yeah, thank you, Alfred. And again, I echo Eli's thoughts. Thanks for having me. Pleasure to chat tax credits, as I love to do these days. I'm at Atlantic. We are an insurance broker. We are a specialist broker that only focuses on transactional risks. Reps and warranty insurance, for example, is our bread and butter. But tax is quickly gaining steam, particularly given the IRA and the subject matter that we're talking about today. Just a little background for me going into this world. I've been there for about a year and a half, but I used to run a tax equity desk at Credit Suisse for 14 years before joining. So, I used to do it the old-fashioned way with just tax equity, when we were around circa 20 billion. But now at 45 with the transfer market, it's quite amazing to try to keep up with all the movements. So happy to be here today.
Thanks for being here, Jerry. And Stephanie, everybody had a chance to see you present, but say a bit more of how you come to Crux.
Yeah, Stephanie Detterding, lead our buy-side efforts at Crux, regularly working with groups such as Fortune 100s to private large institutions and family offices and insurance companies. Background is most recently at a tax credit syndicator where I was leading the investments team with a few other individuals, working with investors on tax equity transactions, and we're also lending in the space. Prior to that, I actually practiced as an attorney representing large institutions on all types of tax credit transactions.
Great. And as mentioned, I'm Alfred Johnson. Of relevance to this conversation, I have spent my time between software, financial markets, and the government, including a couple tours at Treasury, once working on financial markets and the Recovery Act, including the 1603 grants program, and then most recently as Deputy Chief of Staff to Secretary Yellen on technology and financial markets issues before the IRA was passed. So with that, Jerry, I'm coming to you first. I just presented data on the market. If you could have gone back in time and shown that presentation to yourself a year ago, what would have surprised you about the way that the market has formed? And Eli, I'll come to you after that.
Yeah, thanks, Alfred. I think the biggest takeaway for me was the fact that demand, and by demand, that's the taxpayers who are buying credits, is currently outpacing the supply. It was always a question at the outset how quickly that chasm would be bridged with the expectation of supply hitting. I think it was pretty close, about 40 billion this year. We've exceeded that as you've shown to the high end. But drifting towards 100 billion, a few years down the road, right? And how quickly would the demand side of it match what the supply looked like it was going to be? I think it's been great so far. I think it'd be very interesting to see how it moves forward, given some of the bigger credits that we expect to see kind of in 45, 6, and 7, with 45V coming online and 45Q potential opportunities to add to the growing 45X as you articulated. So that's been the pleasant surprise so far. I'm very interested to see how it goes from here.
Eli, surprises.
Yeah, I would say, to me, without even getting into the details, the biggest surprise is how well this market is working. When this was first passed as part of the Inflation Reduction Act, it was a dramatic sea change in how tax rules work. The notion, it was an unprecedented notion that people could be able to trade tax credits. There was a lot of doubt whether this would work in practice. And so, to me, the big surprise, and it's a pleasant surprise, is the IRS was able to come out with a coherent and clear sense of rules. A lot of large corporates whose tax departments have not necessarily been revenue drivers or out there looking for opportunities have been able to come up to speed so quickly. Companies like Crux have been able to figure out how to bring buyers and sellers together. The documents have become much more standardized. The key risks in these deals have found places to put them, like insurance or otherwise. And so, looking back, I think this exceeds probably even the wildest expectations of the drafters of these rules, that they could have create such a large and efficient dynamic market.
Totally agreed on that. And Stephanie, you've spent decades in this space. What do you observe as surprising based on what we're seeing in the market right now?
Yeah, and I think it goes a little bit to what Eli was saying. If I'm looking at what my hopes were entering into the transfer credit market, it was that maybe you would have people transacting on technologies that maybe had not seen tax credit capital in the past because traditional tax equity was not available to them. And I think the slide where we talk about the composition of the diversity among the different technologies is great to see. And I'm seeing that in day-to-day practice with buyers looking at different types of technology. Tax equity deals in the past were long and document intensive, maybe due diligence intensive, and the speed that we are seeing deals move has been really interesting. And we have the data to support that it really is going faster in the transfer credit market. And then the other thing I would say is just that new buyers are entering the market. So the majority of the buyers that I am speaking with on a day-to-day basis never transacted in traditional tax equity for a variety of reasons. And now they are entering the market for the first time and they are buying transfer credit. So it's been really exciting to see, and it's been a fun market to be a part of.
Cool. So getting into deal and diligence processes, Eli, I showed pricing on a number of different credit types, ITCs, PTCs, different technology. Two-part question. One is, what do you see as different in the way that deals come together in different technology types? And then I want to fold in a question that we got in the chat from Anwar about the relationship between traditional tax equity and transferability, and particularly, Eli, reflect on how you see diligence processes on credits that are being sold out of traditional tax equity partnerships. But first, start with the different credit types, and then let's reflect on T-flips for a second. And Jerry, I'll come to you after that.
Yeah. Very broad question. Let me say a little bit about both, and then you get Jerry's views or your views and come back to me. I think when you think about different technologies, I think the first split and the main split is the type of credit, whether you're talking about an investment tax credit or a production-based credit, and that largely drives the deal. So in investment tax credit, and you alluded to this very clearly when you laid out your slides, the primary risk is that it could be clawed back or recaptured by the government within a 5-year period. Production-based credits, the primary focus point is around the duration of the commitment, because production credits generally will run a number of years. Wind will go 10 years, carbon capture will go 12 years. and so on. How people approach diligence varies among buyers. For larger projects that have already been diligenced, maybe by debt providers, maybe by tax equity providers, going to your second question, you already usually have a fully blown built out data room. The sponsor usually has all the diligence items at the ready. And it's mostly a question of how much the tax credit buyer wants to see and how onerous that process is going to be, rather than the seller not having the information available. Other things that can drive the diligence is around tax credit adders, which are some types of projects could qualify for additional tax credits. Those often involve some level of diligence. More projects these days now need to comply with union labor rules called prevailing wage rules. If that is the case, that drives some diligence as well. And then in some types of investment tax credit deals, you'll have questions about the amount of tax credits, which sometimes are valuation questions, which need to be informed by third-party experts. Jerry will talk much more about this, I'm sure, but many of these deals, a buyer will also require an insurance policy. And so that will then require the insurance provider to do its diligence as well. And that will often happen in parallel with what the tax credit buyer is doing. Some of the newer credits usually take longer to do. By newer credits, I mean not solar investment tax credits or battery investment tax credits or wind production tax credits. People just are less familiar with the technologies, understand the projects a little less than they do the more conventional credits. And so you can have more diligence and education around that. I'd say very briefly on your second question and then pause. We certainly see a big trend of deals that are done as tax equity deals, where then the tax equity partnership then sells the credits. They come in a wide range of flavors, from the sponsor selling the credits to the tax equity selling the credits. Big takeaway on those deals is usually the fact that the tax equity has often already diligenced many of the credits, and so the diligence is there. And another key fact often is that when credits are retained rather than sold, the first loss position rests with on the retained credits, and that is perceived to offer some more security to a buyer.
Jerry, risk and diligence and the associated insurance policies are your business. Would love to hear you reflect on what Eli said there, what you're seeing in the market across different technology types. And then Stephanie, would love to hear your perspectives on T-flips and what diligence looks like on those, and potentially some of the other structures that we're seeing. There are a number of questions in the chat around that. Jerry, first to you on risk and diligence.
Yeah, thanks, Alfred. And I won't repeat a lot of the things that Eli said, but I agree wholeheartedly. Most of when you think about insurance for these things and the diligence it requires, almost all of it is something that's already been traveled, particularly if you have a tax equity investor involved, because they're going to be owning the risk much like the insurer would if it's been passed off to the insurer. So not a lot of extra work to be done there. The one caveat tends to be a little bit more on the tax memo or tax analysis, if there's any sort of tricky tax issues involved on adders or something of that nature. But ITCs are the most laborious. They have the most risks that are covered because they include recapture, as Eli mentioned, which is a big one. And basis step-ups is really kind of where the most of the meat is on these deals. It's where a lot of value can be found. But it's also where a lot of attention comes in, because it's also the most scrutinized when it comes to an IRS analysis, and therefore a lot of attention spent at the front end by insurers. One thing before passing up to Stephanie, I think in addition to the T-flips, I think people like to hear about the preferred equity structures too. It's a little bit, call them tax equity light. They're not taking the tax benefits, but they're doing a similar process and enabling some of the same sort of results. Maybe to you, Stephanie?
Yeah, so we see multiple structures utilized on our platform by which the transfer credits are being sold out of. And that can be a T-flip where the investor is retaining a portion of the transfer credits and maybe standing in a first loss position, or as you referred to, a tax equity light, a pref structure where maybe someone did some due diligence, they're staying in the partnership, but they're not retaining a first loss position. And with those constructs, buyers have different questions, right? So depending on who the tax equity or pref equity partner is and their reputation, that can really provide a lot of buyers, the transfer credit buyers, with comfort related to the due diligence process, right? If that's a bank or a large, well-known institution, their due diligence process is definitely giving buyers comfort related to their due diligence. Additionally, as it relates to step-ups, we do see step-ups being compressed in the market generally. And I think whether or not buyers are getting comfortable with that is a number of factors. Again, is there someone retaining a first loss position? Who else is undertaking the diligence? What does the sponsor financial wherewithal look like? What's the indemnity being provided? And then, Jerry, insurance comes into play, right? And what's being covered, and what kind of loss position can be covered there. So we do see these discussions happening. We do see buyers getting comfortable with multiple structures just because of the parties that already have undertaken the due diligence. But I do think to the extent that there's extra nuances on a transaction, especially for a first-time buyer, it can slow down the education process and the risk analysis. So anything that you can do to kind of speed up the due diligence process is helpful.
Jerry, we just got through our first final filing deadline associated with the 23 market. This is such an interesting market in that deals on the prior year tax credits can transact until the filing deadline in the subsequent year. So we saw 23 deals transact all the way up until October. Some of those deals came down to the absolute wire. What do you think we learned from that process?
Yeah, it was mayhem, to be honest. There was a flood of activity, and I put them into a couple buckets. The September 15 deadline for us was the most heavy. What has to happen for selling a credit, it has to be sold before either the seller or the buyer files their tax return for that given year. And through extensions, partnerships have a date of September 15, or it turns out 16 because 15 was a Sunday this year. And then corporates have until October 15. So September 15, most of our sellers were partnerships in form, and as a result, had a huge backlog of deals that had to get done. And I think what I learned from that was a couple of reasons for that. One, it was brand new. This is the first time you were going through this. Two, it took a long time for the transfer portal to come up and running, to get up and running. So that delayed a lot of folks as far as how they were going to handle it, how they were going to report it, how they had their internal policies in place to be able to transact. And then separately, also new is matching buyers and sellers. Had a lot of false starts, right? So what I think the big takeaway for me and for sellers here is start early as soon as you know that you have credits to sell. Don't wait until the last minute, because what happens in the last bit, and unfortunately we saw some, is that some people lost their credits entirely because they couldn't strike a deal in the waning hours of that period. There was too much of a backlog of work from the insurance side, from the lawyer side, and from the deal side, that they just couldn't end up getting there at the end of the day. And that's an awful place to be, right? So start earlier, make sure you accept a good deal earlier in the year as opposed to later in the year, and put your projects at risk. That would be my advice.
Eli, picking up there on Jerry's encouragement for preparation, what would you suggest based on the experience with the 23 credits that buyers and sellers should be taking into account as they approach the market?
Yeah, and some of what remains to be seen is whether it's kind of first year growing pains that you do get this rush to September 15th. I suspect some of these buyers and sellers didn't know there was a September 15th deadline until a month before, right? This is their first time doing it. It is certainly the case that the seller's leverage declines rapidly, at least for many sellers, as you get close to the deadline, because it could be valueless to you. You certainly can't transfer later. You may be able to carry it forward, but you may never be able to use it. And for many buyers, it's nice to buy credits. They get the discount, but it's not a transaction that would make or break them if they ultimately couldn't do it. So more important, I think, for sellers to get out there more quickly and find a deal. Practically speaking, a lot of sellers are doing this anyway, not so much because they're worried they're going to run out of time, but because, like Stephanie mentioned earlier, they want to unlock capital for their projects. And one of the ways to do that is to get a binding commitment. So it's in their interest to try to get it early. It's also the case that many of them want the capital as soon as possible. And so once your project is done and your credit is earned, simply sitting on it and waiting for someone to buy it usually is just a present value degradation of what you can get. On the buy side, I think one of the lessons learned is that you're not the only player at the table, and it's not the case that you can sit there and just ask for your terms and wait for someone to give them to you, at least not necessarily for the types of projects and types of sponsors you may want to do business with. Um, I think for many buyers, it is a multi-level approval process internally. It's not one, you need your tax department on board, and then you take it to your CFO, and then maybe it goes to other credit committees and a lot of different people weighing in at the same time as they're trying to balance what their tax liabilities are. So it's understandable it takes people time to work out those quirks and kinks, but buyers who are able to move fast and get their organizations in line and organized, I think will prove to do better deals and more value accretive deals.
Such an important point on preparation, and Eli, also the fact that the competitive nature of the market just informs necessities around the deal process. Stephanie, you made observations during your presentation about how competition is increasing in the market. What would you observe about competition? What does it mean for the way that people should prepare for these transactions? And I just want to build on that question with one from the chat, which I think is a really smart way of positioning it. What's the top decile of people that are navigating competition well in this market? What are they doing, and what can we learn from them?
Yeah, all great questions. So, if you are a taxpayer and you're looking to purchase credits and have insight into your future tax liability, there is less competition, as we discussed, around forward commitments. But separately, what I'm actively working with all buyers is really how to prepare to transact. And there's a handful of items that we talk about. So the first, and as Eli talked about, a lot of the entities that are buyers have multiple levels of approval internally. And so we try to work on getting some of those approvals in hand really prior to transacting. So that means internal education, trying to come up with your investment guidelines, figure out, are you going to focus on investment tax credits or production tax credits? What discount rates are you looking for? And really come up with a plan to execute prior to maybe entering the market, so that once you find that transaction that you like and is a fit, you can move very quickly and are not held up by internal approvals. Additionally, we find that those players, both on the buy and the sell side, that build out a team to transact with. So on the buy side, that may be tax credit counsel, right? Sophisticated counsel guiding you through these transactions. It may additionally be a tax advisor. On the sell side, also attorneys, insurance brokers, Jerry, right? I'm sure you get brought in regularly with sellers, helping to educate them and prepare to transact, and have insurance in place to the extent that they know that they're going to need that. And it can also be things like making sure that they have their PWA buttoned up and working with different parties. And so on the Crux side, we are actively working with buyers and sellers to make sure that they have those teams in place, and if not, always making referrals to get them ready to transact. Additionally, what we talk about a lot of times is the documentation. So at Crux, we have form term sheet and we have form documentation. You don't have to use it to transact on our site, but we see a lot of parties utilizing those documents as a starting point, and we know that it's helping get deals done more quickly, and I think it's a selling point. Buyers are also running parallel paths on transactions. So they may bid on a couple of different transactions, meet with sellers, evaluate which one is the best fit rather than going sequentially. And then lastly, I think with competition, what really comes into play is non-economic terms. So pricing obviously is a big driver of, who a seller may want to transact with. But there are other factors that come into play when there is competition beyond just price. And those things are, when can the buyer pay for the credits? Does the buyer have future tax appetite such that the seller can build a relationship with them? I think a lot of buyers and sellers are really looking to build relationships with each other and rinse and repeat in the future. So there are other things like that, Alfred, that I think really come into play. And then lastly, I would just say, if you are a tax credit buyer that has a rating, I think you're also a very attractive counterparty because of the fact that when the seller takes that forward commitment into the market, they can actually point to the fact that they have a tax credit purchase agreement with a rated counterparty is a nice selling point for them.
Agree with all of that. And Stephanie, in your notion of configuring the team, many buyers are also choosing to work with buyer advisors, and that can be a really important piece of the puzzle for buyers that are navigating these transactions for the first time. And we've been proud to collaborate quite significantly with a number of the leading buyer advisors. Jerry, Eli, this question on what top decile people do to get the best results in the market. I'm curious what reflections you guys have.
Yeah, so just quickly, I mean, I think it's the size that they're looking to buy. If you're willing to buy bigger chunks and you're willing to do it on a forward basis, I can't emphasize enough how many asks we've had for that from our developer clients. Just give me some certainty about the future, much like I could get in tax equity, which usually has anywhere from a 6 to 18 month lead time to it, because they want financing earlier and earlier in these big projects, right? So even a commitment that doesn't give cash up front allows the developer to raise cash against it, as a point that was made earlier by Stephanie, I believe, and it's a very big selling point to me.
Yeah, I'd agree with that. I'd say some of it is luck of circumstance, of course. Stephanie mentioned, buyers with strong credit ratings, do get to the front of the line. Their commitments are viewed more positively. Buyers who have, big corporates, and for those of you who've worked at them, are sometimes very slow to do new things. And those that do new things quickly is often a testament to an organization that's kind of bringing ideas from different parts of the organization. And so we have seen some buyers who, by the time they have come to the market, are already educated, organized, have their approvals, have mixed the tax with deal people, and understand that there are, like any transaction, certain risks that they need to get their arms around and cover or mitigate in certain ways. So those are the buyers that we've seen, those that come up the curve quickly and definitively seem to be doing better. On the sell side, I think some of it was, again, sellers with big pipelines, sellers with strong credit ratings, who, big corporates said, this is somebody I could tell my CEO I'm doing business with. So that has helped. But some of it in the beginning, I observed was just old-fashioned hustle. There are sellers who just said, okay, I need to get out there quick. I know who the S&P 500 is. I know where their tax advisors are. I have just mapping out their connections, finding people like your company, Alfred, and others, and just getting out there quickly with their terms, with their projects, and why their deals made sense. I think those people did the best in the last round.
Yeah, Eli, I totally agree with that. And particularly the point that maximizing the number of conversations that you are having as a seller accrues to the benefits of the outcomes that you'll see, right? If you're having multiple conversations, seeing multiple bids, you're going to get to a better price and better terms. And that is one thing that we really support our sellers with, is making sure that they are selling in a competitive context and able to navigate that market. And then similarly, on the buy side, we see a lot of benefit from being able to see the widest market and make sure that you are finding the credits that are the right fit for you. Jerry, any reflections on what the top folks are doing? And then Eli, I'm going to come to you on the question of the capital stack.
Yeah, I echo entirely what all of you just said on the top decile folks. One thing I just want to throw out is advisors in this context, I think, are invaluable, right, for both for sellers and for buyers. And whether it's a good law firm like Eli's or a broker like us, we're a free resource. We don't cost anything, but we have seen a lot of things. So I think just talking to the right people around the table who've been there before can help folks get up the curve a lot quicker and be prepared.
Cool. So Eli, we're living in a new world, right? Transferability changed the way that credits are monetized. There was a world that we became accustomed to prior to that in the way that the rest of the capital stack formed around the project. What would you observe about the way that transferability has changed and contributed to changes that we've seen in the way that the rest of the capital stack forms around these projects?
Yeah, no, it's a great question. And it's, it's as people figured out they could trade credits, it's probably where the next area of focus went, which is how do I fit this in my capital stack and how do I do it efficiently? You benchmark back to the old days, which of course are still transactions that happen, where people would get a commitment to do a tax equity transaction and then go get bridge financing at some level against that. The first tentative steps the market took were lenders who, once they saw these tax credit commitments, which of course always have some conditionality on them, began to get comfortable enough saying, this is the same thing, and I will bridge to that. What quickly followed were, people asking to raise capital against uncommitted tax credits and saying, look, in the old days, if I didn't find tax equity, this commodity was worthless, tax credits. It's certainly not worthless today. Someone's going to buy it for something. And the conversations then went to what were the right advance rates, what sorts of guarantees might have to be given, but is there some amount that could be advanced against uncommitted credits? And that market has grown fairly rapidly. There's a lot of tension in those commitments as to how quickly a borrower then needs to lock up that commitment and how much time the lenders will give it. Again, what the advance rates will be. That's become a very common feature. Probably as you look forward, you say, will people bridge against uncommitted credits that have various adders on them where you don't yet know what the buyers are going to do? Will people bridge against uncommitted production tax credits that might have to be sold over many numbers of years? So it's been a very innovative and dynamic market supplied by project finance banks and a lot of other equity and debt providers who have been trying to find a way. Insurance plays a big role in it, but trying to find a way to say, we know there's value here. How do we unlock capital against it? And I think that story is in its very early innings still.
Stephanie, Jerry, anything to add to that before I get to the roughly dozen questions that are in the chat about the election?
Yeah, if you don't mind, just a quick add-on to that. 100% agree, and I think that's the most interesting area that Eli just focused on in the capital stack and the developments in these bridge loans. A couple of things to point. You mentioned insurance. Insurance is a way that if you get it at the time of the commitment or even at NTP where there's no current commitment, but there's an expectation going forward, that helps remove a variable to the funding. Because the funding in those bridge loans is contingent upon construction risk. Will the project you build? 2, will it be a buyer? This is what Eli touched upon. But 3 is does the constructed project fit, qualify for the credits that they have? So that's an element that helps facilitate those financings. And one other interesting thing, on the innovation track, is that there's been some folks out there who have the ability to both be taxpayers and to be lenders, right? Who are coming up with some backstops, funding that says, here's the rate that I'm willing to lend you money on, and here's the advance rate, which probably exceeds what normal banks will do. And they say, if for some reason you can't get your buyers at the end of this, we'll step in and buy at a very attractive rate, right? So it gives certainty to the process. Unclear how much of an uptake that will have, but at least is an interesting development to maybe get more of your capital stacks financed at the outset of these transactions.
Yeah, I'd corroborate all of that. And Stephanie pointed out earlier in the presentation some of the work that we are doing, led by Andrew Shung, to support our developer partners in accessing capital of other kinds. And one of the things that we're finding, to both of your points, Eli and Jerry, is the tax credit sale ends up being a mechanism by which some of the later stage construction and bridge financing may be collateralized or taken out. And developers are looking for ways to tie other kinds of capital and source other kinds of capital from the market. Because really what we're doing here broadly is trying to recreate and establish the most efficient capital stack for developers that may be different for different projects, and finding the market for different kinds of financial products can be challenging for developers, just given the variety of different products that may be available and need to come together to create the capital stack. Great. So there is an election in 6 days. It has some implication to this market, or is expected to. Stephanie, one way of looking at that is in pricing. What do we see from a pricing perspective, and do we see any signal of the relationship of the election to the way that buyers are particularly participating in the market?
Yeah, it's a great question. So the question does come up from buyers related to what are the possibility of changes related to the IRA. And Alfred, I'd love for your take on that. But I think as buyers are looking to the market, pricing is not being impacted, and they are still committing, and they were forward committing. I think one thing to highlight there is change in law risk is typically borne by the seller. So the buyers are not wearing that risk. And so they are willing to still enter the market and forward commit. So we have not really seen an impact to pricing to date. And Alfred, I'll let you kind of talk about what you're seeing from your side.
Yeah, I agree with all of that. The market awareness and understanding of the way that different configurations of the House, Senate, and presidency might influence this market has been evolving, particularly as members of the House and Senate on the Republican side have made statements about the credits. There was notably a letter from 18 different members of the House Republican caucus to Speaker Johnson talking about the benefit of the credits in their districts. Which the speaker then, when later asked about, reflected that if anything were to happen to the IRA, it would likely be with a scalpel, not a sledgehammer. So I totally agree with the observation that pricing and activity don't really show much of an expectation that there will be significant dislocation from the market. Then again, there are all sorts of other implications that the election could have in either direction. For example, Republicans have made a lot of statements, and particularly Donald Trump has made a lot of statements about nuclear and other categories of energy. Democrats have more recently, Kamala Harris put out a statement about using tax credits for other categories like AI and biotech. So I think there are certainly dynamics and different compositions that could lead to influences to the market, including non-legislative ways in which the department handles guidance issues differently. So with 1 minute left, Eli, Jerry, Stephanie, any closing statements on this market? Eli, starting with you.
Oh, just general on the market. Okay, you spared me the election question, and that is most appreciated. I'd say that we have an almost perfect market now, and just tying into the elections. But part of the reason we have an almost perfect market is because there's not a lot of noise around changes. The credits seem very stable. The IRS has put out very clear guidance. There's maybe a few areas that are unclear, but most of it is pretty clear. And the mechanisms for trading are very clear. That is a predicate for a market to remain stable and grow. And anything that changes that status is sub risk to the downside that we should be prepared for.
Jerry, last hot take.
Yeah, just quick. I echo those statements, but I also am really, really interested to see where this market goes. Right, we're only in year 2, 8 more years. Lots of space to travel. Really interested, as I mentioned earlier, on the demand side of things. How do we grow this? It's already very, very fulsome at the moment, but how does it grow to meet 100 billion per annum? That's really what I'm looking to see.
Stephanie.
It's never too early to start talking to people about purchasing or selling your tax credits. I think the more educated you are, prepared, you can better enter the market. And so I think that's what my takeaway would be, is start educating yourself now if you believe you're going to transact on the buy or sell side.
Great. That's a wrap. Eli, Jerry, Stephanie, thank you for all the insights and knowledge. We really appreciate you being with us. And to everybody on the call, thank you for the great questions. Looking forward to talking to all of you later. Have a great day.
Thank you.
All right, thank you.